It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the most famous guy in Texas in the multifamily space. You know him as the godfather of multifamily, the mayor of the great state of Texas multifamily, the guy who pays more property taxes than anybody else that I know, Mr. Michael Becker, smartest guy in the room. How are you?
Hey, Paul, doing pretty good. How are you doing?
Well, your titles keep growing, Michael.
It's just I know, an ever growing list. Luckily, speaking of taxes, really, we got our tax notices and wasn't quite as bad as I was expecting this year. So I think maybe Christmas came a little bit early. wasn't too terrible so far.
Well, it's one shoe that drops in terms of property taxes, because everybody knows that's one of the largest line items on our operating statement, on a P&L that property owners will look at. But also, too, how about insurance? What's going on with the insurance in Texas? Should we look in other states?
That was, certainly went up, and then it wasn't quite as dramatic in the last couple of years as well. So both those were pleasant surprises. Both going in the wrong direction for sure, but wasn't quite as bad of a rate of change as I was kind of bracing for. As everything seemingly has been going up a lot here lately, from labor is becoming harder, and all the materials and input costs and flooring and appliances and fixtures and all that stuff's becoming hard to source and going up. But I got a slight reprieve relative to what I was expecting on both taxes and insurance. I'll take the little wins when we can get them.
I don't know if we've talked about this before, but when the ice storm hit the great state of Texas and put a lot of properties out because of water damage caused by a lot of these high pressure lines, what kind of damage did you have? What kind of concerns did you have? How much money you'll have to spend to make everything whole again?
Yeah, it was about 6% or so of our units in some form or fashion had some level of water impact, Paul, from really minor, just a little bit to some pretty serious, sheetrock falling from the ceiling and things like that. So we have probably 3-4 that will file insurance claims on, maybe a little bit more that'll kind of exceed the deductible. So it wasn't too bad. Kind of what we're still getting on. We're still kind of dealing with it. We're 3.5 months or so past that event as we record this episode today. So it's been a little bit of time. We're still dealing with it. The biggest thing right now that's really the biggest challenge is trying to get some landscaping. Actually, Paul, all the landscaping got smoked. Your palm trees, your Indian hawthorns, and things like that. And then everyone across the entire state had just destroyed landscaping. So trying to get some new stuff in is challenging. From the stores, the gardening, landscaping supply stores, and gardeners and things like that are really, really hard to find, because it's not only the commercial buildings, also the residential buildings. So if you walk on any apartment in Texas, I'm sure the landscaping looks like crap right now, because just hadn't had time or the ability to get it replaced yet.
A lot of people who don't own multifamily properties maybe can't understand the challenges that you have when water pipe breaks or there is a fire on a property. You've had numerous fires. You've had, I hate to say this, but numerous deaths, and you've had numerous water leaks. I mean, in somebody's mind is, I would think a death is a bad thing, but a physical fire, provided that nobody was hurt, what type of a benefit will you incur if you are an owner of the real estate? And what's the detracting thing about having a fire or a water penetration or a hail on the roof?
Yeah, it's negative from the standpoint. Obviously, you deal with it and disrupt your operations and potentially displace a bunch of residents and things like that. The silver lining, I guess, would be that you get insurance paid for a healthy percentage of brand new upgraded unit or a new roof or things like that. When I first started, before the insurance the market was a little bit tougher back when I was kind of getting going, and for a long time, you get relatively reasonable deductibles of $25,000 or $50,000 for wind hail. So like your roof. So you kind of had an older roof. You kind of prayed for a hailstorm, Paul, because it cost you $50,000 to get a $300,000 roof or something like that. So you kind of actually make out on it. But nowadays, most of the deductibles in the state of Texas for wind hail are materially higher. You're getting 2% deductibles for wind hail. So I mean that effectively means you're most likely in most cases self-insuring your roof for or damn near self-insuring your roof. So when the hail comes through, we're praying that it doesn't hit us instead of hitting us like a few years ago. And then, then you have different deductible levels for, all of the perils. So, a fire, a flood, something like, someone runs a car into your building or, something like that. You have a much lower deductible for all of the perils. So, if you have a building burned down, like I've had happened to be in the past, spend $50,000 or whatever your deductible amount is, you get an $800,000 claim, and then you got 8 or 10 brand new upgraded units that you should be able to get $100 more and rental income, and thereby extension, increasing the valuation of your building. Obviously, having less of claims will increase your premium you pay in the future, because they look at kind of historical losses. So it's not exactly in a vacuum here, but generally speaking, that could be the silver lining to it. We actually had a senior housing deal. We have one senior housing deal that we own, Paul. And with the snowvid, that deal had a fire sprinkler burst, and it flooded 50-something units, which was kind of a mess. And luckily, we had plans on upgrading a bunch of units that COVID kind of put the brakes on. So we didn't upgrade really any of the units because we bought it right before the impacts of the lockdowns from COVID started hitting. So we ended up basically getting 50 of the units done for our insurance deductible of $50K. That we had otherwise budgeted money for. So got a little bit of a break. So that's a good example of something that happened to us recently.
Yeah, positives and negatives that come in the market. You just never know when you're going to have a catastrophe hit your property. But one of the things that I know that you are keeping an eye on is lumber prices. And this is really maybe coming in the question that a listener has from Utah, which I think is is a pretty good question, is Michael, what the hell's going on with multifamily these days? Tell me what you know. So, what's going on, Michael?
Man, we've been in a really good market for a very long time. Had a little bit of a pause for a few months last year in 2020, and then really this year it's been absolutely on fire. I mean, the prices kind of moved. I mean, I remember thinking, and I think we probably had conversations here. I know I certainly interviewed Nick Flewellen, which I think we replayed on this show. I remember talking with him fourth quarter last year, I think is when we recorded that episode. And talking with Nick, it was really, thinking we just bought a brand new Class A building, Paul, last year, and we got like 79% leverage or something like that on this deal. That the brand new deal right from the developer underwrote so well that I could get almost 80% leverage on it. And I remember thinking at the time and talking to him, I was like, hey, I think one or two things are about to happen. One, either interest rates have to go up materially, or two, cap rates have to compress. And turn the clock over into 2021, and the latter happened. Cap rates have compressed dramatically. We just talked about the big snowvid event of February here in Texas, and seems like as soon as the ice melted from the weak cold front, the multifamily market just has been absolutely on blazing fire ever since that moment in time. Operationally, the rents are up a lot. I've been thinking, I think I quoted on one of the previous Mike Mondays, I think my crystal ball a month or two ago was that we're going to probably see 6% rent growth in Dallas-Fort Worth and 8% organic rent growth in Austin. I think I'm going to be wrong on that. I think it'll probably be closer to 8% in Dallas-Fort Worth and 10% in Austin. So these real-time lease trade outs are dramatic, and we're getting materially higher rents, or we're jam-packed full. I'm more highly occupied today than I've ever been in my entire professional career. We have, we're just kind of busting at the seams with occupancy, so it's really forcing rental rates. And that's just not kind of limited to us. That's generally speaking what's going on in the industry. Capital is flooding here left and right. We're getting all the people that have been here and the participants in the markets for a long time are still here wanting to buy more. You're getting people coming from other industries that would buy other asset classes in the commercial real estate space. So people that would buy hospitality, retail, or office, or trying to get either industrial, multifamily. So that's driving it. And now we're starting to see a lot of these institutions that kind of redline Texas in a lot of ways from our big bust that happened out of the late 80s and the RTC days. They just haven't been back in 30 years. Now they're back in a big way, and they're allocating a big chunk of the money to kind of some of the markets like Phoenix, Dallas, Atlanta, Houston, Austin, some markets they historically haven't participated in the recent past they're back in. So it's just insatiable, the amount of, almost obscene, the amount of capital coming after some of these deals. That's really driving these cap rates down and in a material and meaningful way. Another good kind of anecdotal thing is I was talking with the broker today that we bought a deal in Austin from last year, and we're just kind of catching up. And he was just talking about how his opinion is a great time to sell some deals in Austin, but every owner he talks to doesn't want to sell because they own an apartment in the hottest market in the entire country, which is basically Austin, Texas right now. And so none of the owners want to sell. There's so much demand and capital going there. So any deal that's going live is going to have just a tremendous amount of interest in it. So it's just, further exacerbating the price increases. And, it's just certainly a seller's market right now. I think it's insatiable. But with all that said, I mean, it's great if you own a bunch of stuff. It's very frustrating if you're trying to buy. But, I honestly don't see what stops this run that we have for the kind of near to intermediate term. I think we got a good 3 to 5 years ahead of us where we have, maybe not the same crazy pace that we're seeing right now, but a pretty healthy growth. And I think it's going to be, worth a lot more here in 3 to 5 years than it is today. So we're trying to keep as much as we can and buy more.
It really is amazing on some of these new construction deals, whether you're in a single family new construction or in a multifamily new construction, the lumber prices, like we were talking about just right at the beginning of the question, really have tripled. Lumber prices have tripled, and the OSB prices are up more than 250% since last spring. So, these apartment buildings are made with pressed wood and materials that are in short demand. So I think what we're seeing also too, when you build an apartment building, we've had spikes for last year per unit up about $13,000 to $20,000 a door per unit in just wood increases alone. So not including all of the vinyl plank flooring that you get in from China or any of the fixtures, the lights that come in from, say, Vietnam or China that sometimes will show up on a ship and sometimes will not. So, I mean, the supply market is all screwed up in that. I think what I heard, 25,000 deliveries was going to be for this year in 2021, 20,000 for next year. This is just in the Dallas County area. But things have kind of gone off the railroad tracks, and a lot of the builders that were going to be building properties, starting today and be delivered 2.5 years from now. I mean, I think 80% are pens or pencils down trying to figure out what they're going to do on building new stuff. Do you think that's one of the reasons why these prices are going up too? Is that there's going to be lack of inventory of products?
Yeah, I think you're seeing that too, because I think you're seeing some of these developers saying, hey, built this current project for 170 a door, and and it's in town, and maybe I can sell it for like 180, 190. It's not the return I wanted because it's kind of in town, where the suburbs have the high hand, and the in town market's a little softer. But if they go, try to bid out the next deal they want to build, they can't, replace it for less than 200 a door to their costs, and then they got to have a profit margin on top of that. And so they're thinking like, shoot, I can't sell it for this because I can't replace the next deal for anywhere close to what I can sell it for. So I'm just going to hold out for a higher price. So I think that's part of it that's driving it. And then two, a lot of the capital that goes into existing stock and, also goes and funds a lot of the developers who develop new apartment stock. And so they're seeing some of the escalating costs. So to them, it makes a little bit more sense to maybe buy something that's already on the ground with cost certainty versus trying to go into an uncertain cost market and develop. So, I think that's part of it as well. You're exactly right about a lot of this equity. I think, talked to a lot of people and kind of my day-to-day life. You're hearing these developers and they think they should be starting 10 projects this year and they're only going to start 2 because they're having a hard time explaining to the equity and to their lender, like, hey, we costed out lumber when it was 500, now it's 1,300, 1,000 board foot or whatever it is. And they're having a hard time making sense of that. And they don't even know if they can actually deliver it in 3 months when they actually need it, 3 or 4 months when they actually need to get the lumber delivered. What will the cost be? And any sort of cost increase, their equity partner, their lender is going to say, well, Mr. Developers, that's your problem to deal with. So you need to solve that problem if there's any sort of cost overruns. So I don't know, how do you really capitalize a deal in an environment where you can't quantify your cost? So I think it's really going to, not necessarily put a hole in the supply this year or next year, but 2-3 years down the road, I think there's going to be a hole in the supply that otherwise would have been there. The supply pipeline is going to be turned off, this year, and that's going to be felt in 2 or 3 years. So that's why I don't think that this is kind of like a short-lived thing. I think the rent increases will kind of continue over it as the supply chain issues, reverberate over many years as the stuff that should have been built today doesn't get built. We'll feel that too in 2023, 2024, and that's going to be coming in the form, in my opinion, in higher rental rates. That's kind of what my crystal ball is telling me, which makes me be even more bullish about kind of the medium to longer term and the markets that we play in Texas.
Any insight to people who are not in Texas? I know we talked a little bit about the supply chain throughout the United States, but I mean, you're an expert here in Texas, in the areas that you guys own and manage and control, whether it's San Antonio or Dallas, Fort Worth, or Austin or Kyle, areas just outside of Austin. I mean, what's your take? What are you hearing? Are the drums sounding? Anything else in other parts of the country that you're getting some feedback on?
Yeah, it seems like most of the country's doing pretty well from a multifamily market. I think, it's not just Dallas, Fort Worth, or the Texas markets. As I said many times, similar. I think the Sun Belt seems to be kind of the hot hand. Atlanta, Phoenix, Charlotte, Nashville, places like that tend to kind of be the hot hand for the last couple of years. But I'm starting to hear that some of these the gateway markets are starting to rebound, which makes sense with the reopening and people going back to the office and all the mask mandates kind of getting pulled back. I think those cities are going to start kind of coming back. A lot of the young people are starting to be willing to move back into these markets now as the amenities like the museums and the restaurants and the nightclubs and stuff start opening up. It would make sense to me that New York City and San Francisco and places like that will start attracting a lot of the young renter demographic, especially with the rents have now reset 20% or more to the lower side. I think I'm starting to hear things about, why maybe they got a 25% haircut starting in January going forward. They've seen month over month rent increases. So it seems like they kind of bottomed out a little bit and they're not back to where they were by any stretch of the imagination, but they're starting to, get the positive momentum back. So I don't think you can write New York City off that it's dead, never going to come back. So certainly I think it'll kind of bounce back. So I think you're starting to see some of that come back a little bit of Paul as well. So I think, multifamily in general is kind of the darling of the commercial real estate world. And I don't see what's going to take us off its perch anytime in the near future. So I think very bullish overall. As you mentioned, we're, now starting to enter into San Antonio. I'm personally very bullish on San Antonio. A lot of the supply story is, had a lot of supply for many years. And, our kind of thesis is that it struggled for the last, 4 or 5 years when it was kind of delivering similar number of units to what Austin was. Austin, San Antonio, very similar in both size of population and size of multifamily units. And they were both delivering similar numbers of multifamily units. And Austin generally had absorbed all those, as San Antonio was a little bit slow. Well, the developers turned the pipeline off. And, you look up today, San Antonio has about 5,000 units under construction. So it means they'll deliver 2 to 3 a year when it's historically been delivering, 6 to 8. So it's going to be, well under half of what it historically has delivered. Where Austin right now has got 22,000 units under construction or something like that. So it's going to deliver 10 or 12,000 units a year. So it's going to be, probably a quarter of the supply that Austin's going to deliver is what San Antonio is going to deliver. So you're starting to see all these projects kind of struggle to get occupancy, had a lot of concessions. As I drive around, look at a bunch of deals in San Antonio, I think most of these deals are about 95% physical. Concessions are either off or largely off these deals. So I personally think it's a good time to enter San Antonio. As you know, we're about to come out with a 2-property portfolio in San Antonio. So very, very excited about it. It'll be our first 2 deals there. We're going to have an urban deal and a suburban deal. So we're looking forward to get those going. And, I know many people have heard us talk for many years. I don't normally pitch deals or anything like that, but if anyone's interested in potentially investing with us or learning a little bit more information about those deals when they come out in June, I just encourage you guys to go to our website, which is www.spiadvisor.com. That's SPI like spy, advisor.com. Fill the contact us form out and let us know that you want to be on our list and get information when that deal becomes available. We're real bullish and excited about it. I think we're getting them at really good cost basis at a really good time and 2 really, really good submarkets within the city.
Well, that sounds good. That's the probably the end of the end of the podcast right there. We don't usually talk about future deals, but because everybody has to have a relationship with Michael to get going. So we certainly do appreciate it. Michael, as you know, is a former banker that turned the corner and became an investor and owner of multifamily real estate. He kind of started out like you a number of years ago. He bought his first rental house, and that became 14 rental houses. And just like in Monopoly, he traded the rental houses in for an apartment building, and then he became not just one apartment building, but over 10,000 apartment units. So we certainly do appreciate Michael being on the podcast with us. Michael, again, if anybody wanted to get a hold of you, what's the best way for them to get a hold of you?
Yeah, no, the easiest way is like get on our website, which is spiadvisor.com, fill the contact form out, and send us your information. Let us know you want to get added to the list. And got these 2 deals coming up, pretty excited about. So love to get that in front of anybody that's an accredited investor and is interested in potentially investing alongside of us.
Excellent. All right, Michael Becker, we certainly do appreciate it. Again, I'm Paul Peebles. Have a great day.